All right, Bulls and Bears, hope you're doing good. Back with another dose of economic reality. A lot of financial news, economic data here to get caught up on today. Here's what we've got on tap. Jeff Bezos, another huge sell-off in his stock position here with this company, Amazon. We're going to talk about is that a big warning sign. We're going to get into the big spike in credit card debt and spending patterns for the consumers. What else? Another bank creating fake bank accounts. It's not Wells Fargo this time, it's a different bank. Um, Pretty big spikes in inventory in many cities and housing. So we're going to dive into real estate and the housing bubble in this episode. What else here? More store closures, more pharmacies shutting down a lot of stores. Kind of alarming, right? So let's go ahead and get right into it. Please make sure that you are subscribed. So the bankers, the powers that be, the ones that steer the economy, the central planners, they're out there making sure that the economy continues to grow. And how does the economy grow? Well, you have to keep loaning out money. You have to keep allowing people to get further into debt. You have to make sure that the banks do not decrease the credit limits, that they continue to allow people to go deeper in debt by extending the credit limits, right? So we have this scheme going on right now where banks are making sure the economic growth continues. We talked about that in many episodes, but let's talk about first, before we get into the bank that got caught issuing fake accounts and other things, we'll talk about it. Jeff Bezos selling $5 billion in Amazon shares. Now they're saying here it could be raising cash for Seattle Seahawks purchase, of course. There's people out there in the economic world saying that this is a huge red flag, that this means there's a collapse coming next month. Other people are saying, no, there's rational things that he's looking at or doing that would justify this type of stock sale, right? So I don't think it's as a big of a red flag as some people are making it. For example, this was a $5 billion sell-off in shares, which equaled about, let's see here, 25 million shares. But back in February, remember, he sold 8.5 billion. So this is not even as big as the one in February. But when you look at all the different sell-offs, not just Bezos, but a lot of big money people, you start to see, that something may be on the horizon that these people are getting ready for, right? Also, though, people are saying that he is avoiding the Washington state capital gains tax and moving to Florida. He got a place in Miami, so no capital gains tax in Florida. So that could be a reason behind the move. So maybe it's a huge red flag, maybe not. Do with what you will with the news. Do with the news what you will, if I could speak today. Also, speculation growing that Bezos is raising cash to make a push to own a national football team. Bezos previously linked with making a bid for the Washington Commanders, a DC-based NFL team. So we see Bezos expanding his empire. I think if he was that worried about a collapse, he probably wouldn't be talking about buying football teams. But maybe he knows that Americans are crazy about sports, especially football, and even the brokest of broke people will pay to go watch football games. Was it a few reports ago we talked about a person that only made about $50,000 a year, but they spent $5,000 for some college football bowl game tickets, right? On a $50,000 a year salary, you're going to spend $5,000 on one football game for a few hours of entertainment, right? Insane what people are spending their money on, but when credit card companies are allowing this type of thing to go on and allowing people to go into endless debt, which seems like endless debt, you have to question yourself for not spending money, right? If they're giving out money for free, why not just spend it? It's not really money. It's just digits on a screen. It's just a plastic swipe. And I think that's what people have associated money with now. It's just a plastic swipe. It's no longer coined. It's no longer something that you worked for. It's money that you clicked a few buttons on the internet and you borrowed. You did a balance transfer, whatever. You swiped the card. I think people have detached themselves from what real money is, which is money you used to have to work for, money that was physical, tangible, something that you saved up. Now, it's almost foolish to save it up because inflation's going to outpace your savings, right? We told the story here about a couple that saved up for a home, was starting about 5 years ago, and every year they would have more saved up, but every year they were further away from making a sizable down payment on a home. I think they were trying to save up 20%. Every year they were further away, even though they were saving more each year, because the home price increases outpaced what they were saving up. So they would have been better off just biting the bullet and buying 5 years ago. And, it's sad. It's sad that savings has been punished over the past 10, 15 years with ultra low interest rates. Savers have been punished, and the winners have been people that took out the most debt, borrowed the most money. For example, buying a home that you couldn't afford. Home prices doubled and tripled in some areas. Some people sold at the top. A lot of people, though, are stuck. They can't sell because they're afraid of getting another mortgage at a higher mortgage rate. And there's not much cheaper housing out there. Even renting is not cheap anymore. So it's pretty interesting. We're going to talk about housing a lot more here in just a few minutes. But first, Americans added more than $11 billion in credit card debt in May. And I've been telling you about how this is working, right? Back in 2007, 2008, when delinquencies were already at the levels where they're at now, banks were pulling back on issuing new credit. It was very difficult to get a loan. Credit card limits were dropping. If you look at a chart of debt actually decreased because banks were very restrictive on their lending and became very tight on issuing credit. In May, according to the Fed, American consumers added $11.3 billion to what they owe on credit cards. And this increased consumer debt higher than economists expected. Let's talk about the total debt. Well, I got a spider here, sorry. Spider just came down from the ceiling. I'm not sure if you saw that. He was looking like a daddy longlegs. Now I can't see him. If it would have been one of those thicker spiders, I would have probably jumped up out of my chair. But it was daddy longlegs, I would think so. Actually, people are spending. He said the average interest rate is over 20%. Loan delinquencies that are 90 days or more past due are the highest in more than 10 years, right? You would think that would be red flags, warning signs for the banks, that the banks would be cutting back on issuing credit, but they're not, right? I think someone got in the ear of the banks, and they're telling the banks, hey, you better keep loaning out money. You do not want the economy to crash this year, 2024, especially with what's coming up in November. They want to keep the economy looking as good as possible. And I think some people probably got put on notice. Some bank CEOs probably got put on notice saying, hey, you better not pull back on the lending because the economy's got to continue to look good with this economic growth and consumer spending, people swiping credit cards. Let's talk about the latest bank with the scandal here. And this is how CNN put it. A bank created fake accounts, forced clients into unnecessary car insurance, and repossessed vehicles when they didn't pay. Now they have to pay $20 million. Now, usually these fines, usually they equal a slap on the wrist compared to what the banks actually made with all their shady deals, right? This is Fifth Third Bank. I haven't seen any Fifth Third banks here in California. I could be wrong. Fifth Third Bank agreed to pay $20 million, illegally charging customers for unnecessary auto insurance policies. It estimates the practice harmed more than 35,000 customers and resulted in vehicle possessions more than 1,000. Wow. So a lot of times what these banks will do, if they don't get your proof of insurance each year, let's say your insurance company doesn't send it to them, or they send it to them, but they send it to the wrong address, so it doesn't get filed properly. The banks that issue these car loans, they'll go out and put their own insurance on the vehicle, and it's usually a lot more, and sometimes really a lot more, like double, compared to what you can get on the market for car insurance. So I think that's what they're talking about here with the car insurance, because as a lien holder, as a bank, you want the car to be insured, obviously. But the way they were doing it was very shady. For illegal automobile insurance activities, the bank must pay $5 million to redress the affected customers. In addition, the bank pays $15 million in penalties pertaining to practices that incentivized employees to create fake accounts for customers. Remember the Wells Fargo scandal that happened many years ago? Sounds very similar, right? So why aren't banks more afraid? Why aren't banks more afraid of doing this type of thing? Because the punishment, again, is just a fraction of what they usually make in business. I think that's what it is. Please let me know what you think down in comments. Moving on here to the housing market, right? We know that home prices are still remaining elevated. Still many cities inking all-time highs. I have to remind people that we're probably the only channel here on YouTube that told you that the housing bubble was not going to go bust. It didn't make me a very popular channel, but we've been right. And it all goes back to the source of money. It goes back to the fiat currency that can be created at the click of a mouse in infinite amounts. So they can keep the housing market propped up as long as they want. And people don't realize that. When it comes down, it's because they let it come down, right? If the housing market comes down, either one, well, there's a few different scenarios. Either one, they let it come down, or two, something broke in the financial markets and the debt markets. Something big came in, like a black swan, like an act of war, a cyber attack where all the banks get taken down, something big, something extreme, or they just let it come down. If it's not something that brought down the entire financial system, then you know that somebody actually made the decision to pull the plug on it here. Listing prices in June were flat, according to Wolf Street. Mortgage rates still around 7%, way too high. Something has to give. So here are some cities that are seeing some pretty big increases in housing inventory. A lot of these are in Florida. Here we told you Florida was going to be one of the first cities to start showing home price weakness. We were right about that, but not a crash by any means, though. Prices coming down, but not a crash in Florida. Tampa, St. Pete, year-over-year inventory up 93%. Orlando, Kissimmee up 81%. Denver, Colorado up 77%. San Diego up 72%. Jacksonville, Florida up 69%. Fort Lauderdale, Miami up 67%. This is all inventory year over year. Seattle, Tacoma 62%. Atlanta 58%. Phoenix 56%. San Jose 53%. Memphis, Tennessee 53%. Dallas, Fort Worth 52%. Charlotte 49%. San Antonio, Texas 48%. Sacramento, California up 45%. Riverside, San Bernardino, California. I'll stop there at the top 15. So that type of spike in inventory, where in some areas it's almost doubling, that is an indicator that there's weakness happening, or things are weakening, right? We know that sales have plunged near all-time lows for the annual sales figures on homes because the mortgage rates, many people priced out of the market, but there's still not a lot of inventory. Not enough people are putting their home on the market. We also have a lot of cash buyers out there, mostly the companies in the top 10% still buying up homes in California. It's about half of all homes sold are sold to big money investors, investment companies, etc. So we'll keep an eye on the housing bubble for you. We'll let you know if anything drastically changes. I don't see a crash coming in the housing market unless we see some big switch get switched here, where you see something major happen with the banks, right? Here's how Wallet Hub put their one of their recent posts on social media. Credit card debt hit a record high of $1.27 trillion. And that was as of May 2024. So again, banks in record amounts of credit issuance to people and their credit cards. Let's see what else it talks about here. So $1.27 trillion, that's trillion with a T. The average credit card interest rate is 22.7%. And it continues. Banks are still allowing people to go further into debt. Question is, and I've asked here many times, how much longer can consumers last? We see delinquencies are spiking. Back to what we talked about a few minutes ago, the highest in about 10 years. How will banks respond to that? Will they start cutting the credit limits, right? When that starts to happen, that's when the economy really starts cratering. But it's all about the banks. It's about the credit. The economy could keep going if the banks continue to allow people to go into this, what seems to be endless amounts of debt. But at some point, there's got to be a breaking point with the consumer. Let's talk about Rite Aid here. More signs of economic weakness. Rite Aid is to close 40 more stores. This comes on the heel of Walgreens announcing, what was it, about 2,000 store closures phasing out over the next few years. And the economy is good. You know, why are we seeing this many store closures, right? People are getting maxed out. People can't get by. Just because people are making silly purchases doesn't mean people are doing good. Because you see the stadiums packed and the restaurants packed doesn't mean people are doing good. A lot of times it's just people spending money on what they can spend it on, right? People can go buy a $50, $60 dinner. They can go to a $100, $200, $300 sports event, whatever it is, but they can't go out and buy a home. They can't buy a car. They can get a loan, but they're not saving their pennies to go pay cash for big purchases is what I'm saying. Most people anyway, the top 10, 20, even 30%, that particular group are the ones more likely to go out and pay cash for things. All right, let's close it out here with a couple trades that I'm in right now. As you probably know if you've been on this channel, I'm shorting NVIDIA, and I shorted it via a put option just under 135, and it did drop. NVIDIA dropped down to about 118. I was up pretty good. I could have closed out of my option then and took a pretty nice gain, but I'm going to wait. The option I have is good for a couple more months. The stock did go back up, though, to about 132 here. So I'm not up by much anymore. The other trade I'm in, just bringing it up here in my Robinhood account, Rivian Electric Vehicle Company. I'm down on that one. First I was up, it started dropping and went back up, and now it went past where I shorted it. And let me see here. So over the past few days, so I might add on a put option onto Rivian because I still think it's going to go down. And because Rivian stock, what happened was, let me bring up the prices here to go over it with you here. Got to share my screen with you here. Here's what I look at in a stock to see if it's overbought, right? So we look over a year here, we see the spikes higher, and Rivian went to 27, dropped all the way back down to under 20 there. Spiked up again, dropped down, spiked up again here to, let's see here, 24 back in December, dropped all the way down to 15, right? So you can see it's not holding the price gains. It's not holding the price spikes. So this recent one, I shorted right about here, just under $15. It dropped. I was up. I could have closed out and had a little bit of a gain. But look, it went back up to 15, right? But it came all the way from, it was $10, right? And then just a few months ago, it was as low as $8. So I think this one's going to go down just like every previous spike that we saw earlier this year. I think it's being pumped up a little bit now to try to scare some short sellers out of the position to get the weekends out of it. So I'm going to probably add to my position here, and I'm not telling anyone to follow me on this. I'm just giving you some of my strategy, what I look for in stock trades. And there's other stocks that I'm holding that I'm long on. I'm not shorting everything. It just the stocks that surge too far too fast, I look for opportunities to short these, right? And I've gotten some pretty good feedbacks from some of you that did some of the trades that I do. But I always want to remind you, do your own due diligence. Don't just follow my trades. I can make a mistake, right? I could short a stock when I'm tired and not paying attention, and maybe I didn't do my due diligence. So far, these trades are going okay. And I just start off with a small position. That way, if it goes against me, I can either add to the position, and that way get an even better entry point. Like, for example, with Rivian going higher, I'm going to do another short at a higher level, and that'll be even better. And then when it goes down, you make even more. The bad part about shorting a stock is if it goes up, up, and up, then of course you lose because you're betting against it. You're betting on the stock going down. So just a little fun, folks, trying to make a little money here with some of the wackiness here in the stock market. And as far as long positions, I'm not very heavily invested in the stock market right now until we get past November. Most of you know I think this year we're going to see some big things go down. We might even see a rug pull or a plug pull on this entire economic system out of this money creation with some big things, some big risks out there. A lot of black swans, wars, threats of cyber attacks. A lot of countries hostile to the U.S. right now. A lot of risks out there, folks. So be on your toes, folks. Head on a swivel, all that good stuff. Everybody, keep stacking. What do you think about today's update? Jeff Bezos, is it a big nothing burger because he's just getting money to buy a football team or his move to Florida? What is it? Or is it another red flag that we should be on high alert? What do you think about the bank? Fifth Third Bank caught issuing fake accounts, giving people insurance when they didn't need it. What do you think about all this, people? Just the economy in general. Where are we at? Where are you at? How you feeling? Let me know down in the comments. Please make sure you're subscribed and come back for more updates on this channel. Big love. Keep stacking. Bye for now. Peace.